Okay, welcome to Unit 1.4, Business Ethics. Ethics, very intricate type of concept because it doesn't all in all apply to solely accounting, but because of sensitive natures of businesses and components, dollars, cash, money accrued is being handled, we tend to try to hire ethical people and conduct ethical practices. Now, here's what ethics are. You may see this again. They're internalized standards for any company, whether it's owner-operated or a corporation, considered to be the legality of any action performed. It could be selling a product to a customer or documenting the actual transaction in a book or not documenting it. Ethics also initiate what are called internal controls, very necessary in an industry and within the concept of accounting, kind of a checks and balances. Of human action. Now, internal controls are not only for monitoring purposes, but they also allow for an increase in profit. Well, how so? Well, if we comply and enforce rules, abide by law changes as they affect us, and abide by deadlines set for new businesses, if we're doing everything right, we should make out okay, especially in the revenue category. Hence, profitability. Now, there are several primary internal controls for accounting, the industry itself. First and foremost, we have Sarbanes-Oxley. It's an act that was passed on the federal level, otherwise known as SOX. What is it? Essentially, it's a system, and it allows auditors to test and evaluate procedures in the workplace. Here's an example. I own an accounting firm. Bob is one of my staff accountants. I put a check, a random check, for $1,000 on a random table or on Bob's desk. Bob sees it. Bob doesn't question it. Bob ignores it. Bob doesn't lock it away. Bob doesn't even address me or anyone as to why that $1,000 check is laying around. What Bob does in that real time falls under Sarbanes-Oxley. So it's a system that auditors must test and evaluate on a day-to-day basis in the workplace. Also, assessments and audits themselves are often done on books, financial statements, and people. They're evaluations that produce results based on business operations. And they allow for an increase in profit if you're doing things right, as you're following procedure and enhancing quality. A code of ethics. Now, what is a code of ethics? Well, usually they're issued by a third party on a high level called the American Institute of Certified Public Accountants. If you're going to adopt a code of ethics, that's who you would adopt them from. They're a set of rules and regulations. Now, an individual company like Bob should, as recommended, have his own company code of ethics as well. And what Bob would do would be actually to document those, one through whatever, legally and bind it. Law. Well, people break the law, perform violations. Violations are unethical. If I steal from my employer, not only am I breaking the law and could go to jail, but it's obviously unethical. Also, what you need to know is ethics also applies to not everything illegal. I can't go to jail for leaving work early when I'm on the clock, but I sure can get fired, or not. Either way, that's unethical, but not illegal. I'm stealing company time, technically, but I can't go to jail for it. Full disclosure. Now, in a business operation, whether it's the owner or all the way down to the staff, documentation of all assets, liabilities, and equity must be accounted for. We can't hide anything. For instance, if I buy one car and expense it, that's pretty normal nowadays in business. But if I buy 10 cars and only expense eight of them, what am I doing with the other 2? That's a problem. Or, even more so, if I say I bought 10 cars and I only bought 2, that is lying and it's not full disclosure. Conflict of interest. Big deal nowadays in any industry. Politics, etc., but definitely in accounting. A conflict of interest, in this case, is business oriented. A lot of it applies to GAAP, generally accepted accounting principles. And let's just say this. Let's say we're in a situation where I sell products, but I also sell services. So a lot of times what happens is I will bid on a job. Well, technically, the lowest bidder wins. Depending on who's monitoring the bidding process, they could fudge numbers, they could fudge efforts. That's a conflict of interest. Also, let's just say the person doing that with those bids is my brother. That's a conflict of interest. And let's say I get an account that I only received because my brother's the mayor of a town and I own the firm. That's a problem too. Nonetheless, if we follow all these principles, the goal, besides balanced assets, liabilities, and owner's equity, is to articulate and receive accumulated earnings and profits. These internal controls and proper ethical behavior will allow for that. Thank you.